Hey everyone, you're watching CoinDesk's Policy and Regulation Show. I'm Jen Sanasi, here with my co-host Renato Mariotti. Renato, wonderful to see you.
Great to see you, Jen. No shortage of things to talk about again this week.
No shortage of things to talk about. If you're just joining us, if you're new to watching this show, the show is live. You have the ability to comment or interact with us. If you have questions for our guests, please put them below this video. And we talk about everything to do with crypto policy and regulation. Renato, a lot happening today. We have the Senate Banking Committee saying that this market structure draft is being put on the back burner as they start to shift focus and look at housing. And then we have the Egg Committee, unveiling its latest version of crypto market structure text. But it feels to me like things are really starting to slow down since Coinbase pulled their support for the draft, and it almost feels like some air has been sucked out of the room.
I'm very concerned right now, Jen. Very, very concerned because there's really a window here. There are going to be elections later this year in the fall, in November, that are going to determine control of the House of Representatives. That is going to be very consequential. A lot of experts are predicting that the Democrats will gain control of the House. That's not surprising because the Republican majority is only at, I think, 2 votes at this point, and presidents usually lose some support in the House in a midterm. But once we get to election season, there's not going to be a lot of legislating going on in the United States Congress, and so there's a window of time to get this done now. And yet, what we have is the Senate Banking Committee, and you could see the article there that you're referencing, Jen, is basically saying we're going to push this forward a number of weeks. And then, as you point out, the Agriculture Committee, the Ag Committee, they released a draft, which is fine. It looks very similar to the Clarity Act that was passed by the House, but it's not bipartisan. They basically said, the chairman said, we've not reached agreement with the Democrats. And the problem there is simple math. You need 60 votes to get a piece of legislation through the United States Senate. And there are only 54 Republicans. And so, as a practical matter, 6 Democratic votes are needed. And without bipartisan language, you're not going to get there.
Renato, you said you're concerned. A lot of people I've been talking to, surprisingly, to my surprise, have optimism still that this bill will get passed. A lot of people telling me maybe it just doesn't get passed in the way that we want it to. Maybe it's passed in chunks. Maybe there's, for example, language around DeFi taken out, but some version of this bill gets passed. A lot of optimism, and I'm really surprised to kind of hear that kind of optimism happening behind the scenes. Curious if you've heard some similar remarks or what you've been hearing from people you've been talking to.
Well, I think there is still optimism. I think you don't become a successful entrepreneur or business leader without having a certain optimism and belief in what you're doing. But I also am hearing concern as well. I mean, what concerns me when I'm looking between the lines here, Jen, is not as much like DeFi, which you mentioned, but ethics. And the reason
Mhm.
I say ethics, and I know that I'm maybe a lone voice in the wilderness here, is that that's something in which there needs to be an agreement between the White House and Senate Democrats. And getting the Trump White House to sort of reach accommodations with Senate Democrats is something that can be challenging. And
Yeah.
we saw there was a meeting that was supposed to happen with the Senate Democrats and the White House that reportedly did not occur. That is, I think, potentially could from a political perspective blow up a deal at all, and that concerns me quite a bit.
We're going to bring our guests in just a little bit. We'll get their opinions here. But I've heard, in regards to ethics, that the two sides might be able to compromise if two Democrats get seats at the CFTC. Do you think that that's somewhere where there will be some flexibility and we can come to a compromise when it comes to ethics?
Well, I do think that the getting seats at the CFTC is very doable, and we saw some reporting from Bloomberg recently that the White House is considering nominees, including Democrats, which is very significant because the president has not appointed Democrats thus far to any of these sort of supposed quasi independent type commissions. So I do think that that is very notable, and I have heard elsewhere that there, some of the folks are actually, Republicans in particular are getting interviews. So I do think that occurs. I think the question is from a political perspective, will these Democratic senators vote without some sort of ethics provision? And I just don't know the answer to that. But it concerns me because it's the sort of thing that there can't just be a compromise between the industry and banking and others. It's something that it can be a more challenging compromise to reach.
All right, let's get to our first guest now. We have Coinbase's VP of US Policy, Cara Calvert, joining us to talk to us a little bit about Coinbase pulling its support for market structure just a few days ago. Cara, welcome to the show.
Yeah, thanks so much, Jen. Appreciate it.
Thanks for being here. Now, let's just lay a foundation for our audience watching at home. Why did Coinbase pull support? There have been several communications from folks all over the organization, including CEO Brian Armstrong. But just lay it out for us. What are some of the contentious points that Coinbase just couldn't get on board with?
Well, I think what it really starts with is the idea that this bill had less than 24 hours to breathe. And it was a document that was released. Most of it, if any of it, had not been seen before. There was a very small group of people that had reviewed this piece of legislation. And that, I think, was an indication that there were some fatal flaws. And there were some provisions that we knew would get worse with a very, very short window to offer amendments and to try to solve some really important compromises. One of those, and we can talk more about it, one of those was how everyday Americans continue to earn rewards, and how we think about ensuring that the products and services that are out in the marketplace today, how we don't rip that out, especially when affordability matters most. And there are everyday Americans earning millions in rewards now. We need to make sure that we don't take that away from people. A second piece was ensuring that SEC can continue to really use one of its pillars of authority, which is exemptive relief, when they're trying to introduce and allow for new types of technologies, new types of different products and services. That was a really critical piece. There were a few other provisions, certainly ensuring that the DeFi provisions are right, whether it's in Title III under the Bank Secrecy Act provisions, or in other parts of the bill when we think about how developer protections evolve and how those rulemakings really look. Those were the types of things that I think needed more time to breathe. And certainly now, while I understand the concern that this has been delayed a couple of weeks, that is part of legislating. And I think we are all at the table, nobody left. There are a lot of constructive conversations happening. The banking bill is certainly, while I think they are moving to different things in terms of floor debate and some focus there is still work happening behind the scenes. And that's really, really important. You then have the ag momentum. And yes, I agree, Renato, that there is certainly the idea that this is a partisan markup versus a bipartisan markup, and it's simple math. But at the end of the day, we have to get started. And this bill is very reflective of the Clarity Act. And that Clarity Act had 78 votes in the United States House. So we think we're moving in the right direction. We're looking forward to the markup on Tuesday. And we think banking is going to get back on track.
Before I let Renato jump in here, what's happened since Coinbase pulled support? Are you able to give us any insight into the types of conversations you've been having? What has the discourse been like with the White House? I mean, they seem pretty pissed that that Coinbase pulled.
Yeah, it was a serious time. It was a serious week. It is still a serious issue. And we are continuing conversations. Those haven't stopped. This was a very principled position. We had been saying for months that if rewards were put in danger, that Coinbase would have to seriously consider whether or not it could support moving forward. It was very clear that while the ANS had a compromise that we thought would both give the banks what they have been asking for, which is protection from balance-only rewards systems, and while at the same time ensuring that you could continue to reward and give promotional types of activities to different customers. That was, from our perspective, that was a fairly big give on the side of crypto to basically eliminate all rewards for anybody who holds a balance. That's a big deal. And that was completely glossed over in this process. And then we had 6 amendments that would have made the bill materially worse. And that was, I grew up in Wyoming. When you're looking down the barrel of a gun, you don't pull the trigger, right? That is was a big problem for us.
You referenced, and I think Jen referenced some of the White House's concern and pushback regarding Coinbase's position. There, of course, was a tweet or an ex post, I should say, from Patrick Witt saying, and it's highlighted here, no bill is better than a bad bill. Of course, he's quoting your CEO in saying that. I mean, does Coinbase actually believe, and you stand by the idea that having no bill at all, in other words, having essentially no permanence, no permanent legislation, relying entirely on rulemaking is preferable to having a bill that is, only accomplishes certain, partial goals or has flawed provisions in it?
Well, that's a really important nuance, Renato, that a bad bill from our perspective is something that tips the scale to leaving not just the crypto industry and market participants, but everyday consumers worse off. That's what we felt as we were looking at this piece of legislation after 12 hours, that it would leave everybody worse off. It doesn't mean it can't be fixed. And I think that is critically important. These provisions can be absolutely fixed, and I think can be done in a way that doesn't endanger bipartisan support. And that is, I think, what we have to do over the next 2 weeks. And whether or not the markup would have been partisan or bipartisan on Thursday, I think remains to be seen. And so ultimately, we needed the time to make sure that these provisions don't leave all of the stakeholders worse off.
Renato said he was concerned. I said that a lot of folks I've been talking to behind the scenes have been optimistic. It sounds like you share that optimism, Cara, that we will have this legislation before midterms?
I think so. I really do. I believe that this is going to move quite quickly when we get through some of these key issues. And again, I don't want to undersell all of the good things that are in the banking bill. It provides an absolutely critical function of deciding what is a commodity, what is a security, how do we think about network tokens, how do we think about these types of sales and how those impact what consumers need in terms of disclosures. We need to ensure that those disclosures are right-sized and that they compare to, for example, what we see over in MiCA and in the European Union. We need to make sure that the provisions in this bill don't make Europe a more attractive place to launch and to engage in the crypto economy. So those are some critical pieces. We need to make sure that developers can continue to build and develop and do really exciting things here. But again, those are not insurmountable fixes. And the bill has a really strong foundation, coupled with the agriculture bill that also, from Coinbase's perspective, does the most important thing. The most important thing is to give the CFTC spot market authority over digital assets. That is because at the end of the day, the markets are not regulated at the federal level for non-securities.
Doesn't the CFTC have that in the current draft?
In the ag bill, yes. Yes. And that is why it's so critical that these two bills, like Clarity, are married up. And this process between the two markups and even before the markups, absolutely critical that process is seamless between the SEC and the CFTC side. That's what we saw on the House side. They worked together to create one package that was stitched together in a pretty seamless way. That's the process now that really needs to play out on the Senate side. That we think even some of the concerns right now with the banking bill can be addressed in the ag bill, and some of the concerns in the ag bill will absolutely be addressed in the banking bill. But when they're running on two parallel tracks instead of converging, that I think is causing some of the challenges, even with bringing Democrats along.
Cara, I'd like to get in the weeds a little bit on stablecoin, what yield, rewards, whatever term you want to use to describe it. When I looked at that last banking draft that came out, it seemed like it preserved rewards being given to users for using a particular platform, a particular, let's say, exchange like Coinbase or et cetera. What is insufficient about that? Wouldn't that allow Coinbase and others in the space to do essentially what you want to do there regarding your reward and yields? Help us understand.
Yeah, so I think the important thing to remember here is while I think Coinbase has been out in front, and certainly with a decision last week to opt to not support the bill going forward, this has become a central issue, but it really is an issue that impacts the entire industry. There was a letter that went out in December with over 100 signatures saying you have to protect rewards. And that's because there are so many different platforms that are seeing stablecoins as a huge, huge advantage for both businesses and for consumers. So they're thinking about, how do we transition customers from other types of payments or other types of platforms to our own, and incentivize them to leverage stablecoins in a way that benefits everybody. It's like switching phone companies. It's not really that hard, but there's just enough barrier that it's just kind of a pain. And so ultimately, you need incentives. Some companies give away free phones, some give away free months, some give away points. At the end of the day, it's the activity that is incentivizing somebody to use this new type of technology. That's why it was tricky to ensure that if we're thinking about, all right, we don't want to compete with deposits, and we would also, I think, query whether or not that's even a true premise that these compete with deposits. Ultimately, these are payment mechanisms. These are people who are leveraging them for different use cases. They're not just sitting them in, like you do in your, in your checking account or your savings account in your local bank. But ultimately, we were looking at how all of these different, it's been 6 months since the Genius Act passed. That's a long time for new innovations and business ideas to proliferate. So we were trying to understand, what are all the different activities that are happening that benefit consumers, and how can we make sure that if you are holding a balance, you are also doing something else. You are also using it, you're transacting, you're staking it, you're engaged in a loyalty program. All of those things were really important to make sure we got right.
I want to talk about this piece in that original tweet from Brian Armstrong. He mentioned a de facto ban on tokenized equities as one of the sticking points here for Coinbase. Can you talk to us a little bit about that?
Absolutely. So Section 505 was, again, I think took a lot of people by surprise. And all of you, maybe all of you, but certainly all of crypto Twitter, discovered that this was a section that created a lot of conversation. There were people on both sides of this argument. This section did nothing. And then there were people that saying this was effectively a ban on any kind of tokenized equities. We took the position, and we have a lot of smart lawyers. We have a lot of smart people who've been doing this for a long time, who said we are convinced that this would eliminate the exemptive authority of the SEC to write new rules or to exempt from old rules for tokenization. And that exemptive authority is an absolute pillar, as I mentioned earlier, of SEC authority. And when we start to think about tokenized equities, what does that actually mean? What does it take to bring a tokenized product to market? It means not using some of the old rules, like needing transfer agents or needing books and records, paper books and records. It means being able to use the blockchain for those types of things. Really technical issues that don't need a rulemaking to decide. They instead need the ability of smart regulators to say, this just doesn't make sense. If over the last 4 years, we had a regulatory environment where they would have used that, we may be in an entirely different place right now. But you've got the authority, and the idea is this is a race to the top with tokenization globally. Every single country out there that is looking at crypto is thinking about tokenization, and the United States can't fall behind.
You're right that it caused some discourse. CoinDesk spoke to a few CEOs in the industry who work in tokenization, one of them being Carlos Domingo, CEO of Securitize. And he said that the current draft doesn't kill tokenized equities. It clarifies that they're still securities. Some other folks said that they don't interpret clarity as a de facto ban on tokenized equities. How would you respond to that?
Well, I would say if we're having the conversation, the language needs to be fixed. If it is, and obviously very smart CEOs and thinking about this, if there is so much ambiguity or so much concern about the way it's drafted, it needs to be fixed. That is not the intent, I think, of statutory language to create more confusion. I think it's to provide, as the bill implies, clarity, and it would need to be fixed in order, I think, to bring comfort. I think we all share the exact same goal. There is no way that I think anybody wants this to create a loophole for securities regulation. That is not the idea here. If it's a security, it's a security. It doesn't matter if it's tokenized or not. they should have the rules ensuring that they have to comply. But ultimately, if you're requiring the same rules as you've had for the last 90 years, that's a problem. If the old rules worked, we'd be using them.
Well, we've been talking a lot about the issues with the banking draft, which of course we know about because your CEO did put out a statement and laid some of those issues out. I do want to talk a little bit about the Ag Committee draft that just came out yesterday. So it looks a lot like the Clarity Act, but there's clearly some reason why the Democrats on the committee, or at least some of those Democrats, aren't on board. Can you help us understand what the gap is between the majority and the minority on that committee regarding the current Ag Committee draft?
That's a great question. We are also digesting it. I think, we've had it for a little less than 24 hours. So we are looking through that and agree with your assessment that this is very similar to the Clarity Act. And so we are trying to evaluate what are the differences. I would actually posture that this bill includes more provisions that traditionally Democrats have supported. And that, I think, is something that we'll have to evaluate, and the Democrats will have to evaluate. Ultimately, I think that the position of the Democrats right now, and working particularly with the 12 Democrats who have come together to try to find a path forward on this, they span the agriculture and the banking committees. And as they evaluate both bills now, I think that there will be a more clear picture of where there are gaps and where there are not gaps. And that, I think, was one of the challenges, even leading into the banking markup, is what is the role of the SEC versus the CFTC? And without that agriculture bill out there, it was a bit of a vacuum where there were a lot of folks saying, oh, we need to make sure the SEC has more authority here because we don't know what's happening on the CFTC side. Now I'm actually hoping that with visibility across the comprehensive solution, again, knowing that some of these things still have to be stitched together, that Democrats can identify where the gaps are that they're concerned about, and then those can be addressed in the two different bills.
Sorry to jump all over the place.
That's
I want
okay.
to come back to something that Patrick Witt said. I know we referenced the tweet earlier on in the show. He also said if a bill doesn't get done now, it might be done under a less friendly administration. Does that concern you at all?
Well, I think if we go back to the threshold question is this going to leave stakeholders better off? Better for everyday Americans, better for industry, better for builders, better for consumer protection. I think that if that's the case, certainly getting legislation done sooner rather than later is always good. But when you start to get into a split Congress, if the majority flips in either chamber, that's just harder to do. But again, you still have to count to 60. So we will get to 60, but the majority does matter.
One thing I found interesting, Cara, in the Ag Committee draft is there's now basically user fees, you could think of it, for the CFTC, that it has a funding stream that grows with its authority, which is an issue given, there's an OIG report that just came out this week showing that the CFTC is down over 20% of its staff. It appears to be not have the resources it needs to do the job. How concerned are you, or are you concerned about whether the CFTC has the resources it needs to actually do the job of regulating this new spot market authority?
Well, it's a great question, and I think a very real concern. And we saw this issue actually start to come about years ago when this piece of legislation first started being vetted. This, interestingly, on the agriculture side, there have now been at least 5 bills that have looked at how to create CFTC spot market authority. And key to every one of those is, how do you fund it? How do you ensure that they have the resources they need, the manpower they need, the expertise that they need? And a big part of that is the funding stream. Before, historically, there have been 2 choices: appropriations or a fee-based model. A fee-based model, I think, does make sure that they continue to receive and continue to have the resources they need as this industry grows. So that, I think, is I think that is helpful in terms of charting a path forward and getting this across the finish line. It has been a major concern of not just Democrats, but Republicans as well. And so I think that is a really important piece of this legislation. Ultimately, they will need to staff up. Right now, as you mentioned earlier, one of the concerns is how does it look with one commissioner? What does it look like with staff down? How do we make sure that we have people in the seats that can actually effectuate this law?
All right, Cara, we have to leave it there. Thank you so much for spending some time with us today. It was a pleasure having you on the show.
Thank you so much. Appreciate the time.
That was Coinbase VP of US Policy, Cara Calvert. All right, we are moving right along, about to introduce our next guest in, but I want to remind you that we are live across all of CoinDesk's platforms. So if you would like to engage with us, if you have a question for our next guest, just put it below this video and we will try to get to it. Joining us now is General Counsel at Veda Labs and former SEC senior lawyer, Tuongvy Lee. Hello.
Hi, thanks for having me.
Of course, thanks for being here. You heard the conversation we just had. You heard Renato and I at the top of the show. Are you optimistic that we will get this legislation passed before midterms?
I am. I think over the next few weeks we can absolutely get there. I do think it is important to get something done. Crypto is a multi-trillion-dollar industry, and the simple fact of the matter is that it cannot meaningfully grow and flourish in a way that is responsible and protects both innovation and consumers without clear rules of the road. So we need a bill. And like with any bill, both sides have to be willing to compromise. And I agree with Cara, there's room to get there over the next few weeks or month or so.
What issue to you or issues do you think are the biggest hurdles right now to getting across the finish line?
Yeah, so I'll touch on one thing that you guys just discussed with Cara, which is the ambiguity over the SEC's exemptive authority. I do think the draft largely preserves the SEC's authority to create tailored rules for crypto. But I share the concerns about certain language, specifically Section 505(e)(2), that could impose a technology-specific constraint tied to how crypto assets can be issued, transferred, and recorded on a blockchain. And in practice, I think that probably will make it harder for the SEC to use its exemptive authority the way it historically has, right? That it'll create real litigation risk. I don't think it's fatal, but it's the sort of thing that I think does create unnecessary ambiguity and should be cleaned up in a markup. And then, of course, everyone's been talking about the stablecoin yield or rewards issue. And, I did want to point out one thing, which is that I think with respect to this issue, I think we're sort of missing the forest for the trees here. The fight over bank deposits and stablecoin yield to me is really just the tip of the iceberg. We, I think, are undergoing a major paradigm shift where consumer expectations are changing. And I think that any sort of market structure bill that passes, which is something that, is going to be around potentially for generations, right? Any sort of bill has to sort of be future-proofed for that and recognize that, right? Because if you think about the fundamental value proposition of blockchain, it's that you replace intermediaries with infrastructure, allowing people to have more control over their own money. And the natural extension of that is you also allow people to capture more of the value of their own money, right? That said, I think the argument that the banks make is serious, that the system of credit we have in this country would collapse if bank deposits flee, right? But I agree with Cara that the conclusion doesn't necessarily follow that premise or that concern, right? Because we've seen this pattern before. It was the same argument that was made with the growth of things like money market funds and securitization and forms of non-bank lending, none of which led to the collapse of credit, right? It just reorganized the way that credit worked in this country. So I think we're seeing the same thing play out here. New financial infrastructure is not going to destroy our system of credit. It's just potentially going to reallocate it. And so I think that's sort of like the broader picture that we have to keep in mind with respect to this one issue that might seem a lot narrower.
Renato, I want to bring our audience comments in here too, folks commenting about privacy. And I just want to level set here. Is privacy mentioned in the draft at all? Is privacy even something that's being discussed?
I don't think it's been a focus of Congress. I mean, there are a bunch of crypto companies and projects and developers that have been working on things like zero knowledge or ZK cryptography for years. And so I think, we are going to start hearing a lot more about that, because privacy is going to be a really essential part of this industry's ability to scale, and just the ability of everyday users and institutions to meaningfully engage with the blockchain. But I don't think historically it has been a focus, although I think you will see more on this issue in the coming months and years.
Yeah, I agree with you. I think as institutions come in to the ecosystem, privacy is going to be really important for them as well. But Renato, I think I cut you off.
No, not at all. You heard our discussion with Cara a moment ago, and she thought that expansion of the CFTC's authority, particularly over spot markets, was very important. And it appears to me that these two bills in banking, or the two drafts in banking and agriculture, very meaningfully expand the CFTC's authority. I'm wondering if you read things the same way, and what you think the balance should be between jurisdiction of the CFTC and SEC over this space.
Yeah, I mean, I think in a way it's very straightforward, right? The SEC has jurisdiction over securities like it always has, and that is not going to change with respect to securities that are issued and traded on the blockchain. And so the key there will be making sure that we clearly define which digital assets are securities and which digital assets are something else, right? So that could be commodities that, digital asset commodities that fall under the jurisdiction of the CFTC. It could be things like meme coins or payment stable coins, right? Like there need to be clear lines between which regulators have jurisdiction over which kinds of assets and how that's defined. That said, I do think you could potentially see more overlap or collaboration between the two agencies, where, for example, the SEC could be given authority to oversee platforms that may be able to offer more than just digital asset securities. So that's one of the things that I'm watching sort of closely.
We were just talking a little bit about the issue that the banking lobby has with the stablecoin rewards or yield. And I know that you wrote an op-ed for CoinDesk that's going to be published very soon. How do you think that this gets resolved? It sounds like you're saying this is a regular discourse that we're having as we change the financial infrastructure. But how do you think it gets resolved? What do you expect to see next?
I mean, I hope that the different stakeholders here can reach some sort of compromise. I mean, I sort of look at it from like a higher level, or like I try to look at the big picture and think of it in terms of systems, right? So, I'm very skeptical of the argument that, allowing consumers to earn more of the value of their own money is going to lead to a collapse of the system of credit in this country. I think as with any new form of technology, you might see things start to shift, right? So, for instance, if you look at on-chain lending, protocols like Aave, for instance, these have grown significantly, even just over the past year. And over time, I think what you might see is that banks stop being the default lending source for all credit, and they just become one source among many consumer options, right? So the real change won't be credit disappearing necessarily. It'll be credit that's funded and priced in a way that's more direct, and with returns flowing more to those who actually supply the capital. That's what a technology like blockchain potentially enables. So I think, regardless of where this bill lands on this particular stablecoin yield issue, it's not going to reverse that broader paradigm shift that we're seeing.
Well, I want to shift topics a little bit. We've been talking a lot about the market structure bill because obviously that could change the entire direction of this industry. But I do want to talk to you a little bit about a very significant development this past week that I think you would be you'd be a very good person to comment on, which is NYSE's announcement of its development of a platform for trading and on-chain settlement of tokenized securities. And they also talked about, I think, their strategy to have 24/7 trading, potential integration of tokenized collateral. As someone who's a former SEC senior attorney and very focused on tokenization and your discussion of it a moment ago, what's your reaction to that development and what do you think it means for the industry more generally?
Yeah, I think and write about on-chain capital markets quite a bit. And I think that the key thing to keep in mind here, as you're seeing some of these legacy intermediaries start to dive in and experiment with different aspects of tokenization and blockchain, the big thing to keep in mind here is that on-chain capital markets only make sense, right, if you actually are eliminating some of the intermediaries that have historically existed. And so, if the same sort of structure exists, you're just integrating aspects of the blockchain. I don't really see what the value add is there. I do think what the New York Stock Exchange is doing is interesting because it does seem like they are pursuing something more like native issuance on the blockchain, native trading on the blockchain, right? Which I do think unlocks a lot of the benefits of on-chain capital markets, as opposed to what it looks like the DTCC, by contrast, is doing, which is preserving a lot of the intermediary structure with clearing and settlement, as opposed to trying to realize the benefits of trading on the blockchain directly, which essentially allows you to transact in on-chain capital markets without having to have a separate intermediary to take care of clearing and settlement, right? Because that happens automatically on the blockchain. And so, I think it's interesting that the incumbents and the legacy intermediaries are getting involved. I can see why they are doing that, and I think it's smart of them, and I give them credit for it. What I don't want to see is us just recreating the same highly intermediated, highly rent-seeking structure that already exists in the traditional securities markets, just with some blockchain mixed in, if that makes sense.
I asked this question a lot, and since you went there, I mean, is there a threat that happens? Like, it seems like there is. This ecosystem started to try and solve a lot of the issues that a lot of these folks who are now playing in crypto created, and now they're here. And so how do we find that kind of balance? Do you think about that?
Yeah, I think this is actually exactly where the laws and the regulations and the regulators are going to be key. What I'm hoping to see happen is the regulators and Congress, right, in this market structure bill, I want them to give the regulators enough flexibility to allow for on-chain capital market experimentation, of course, in a way that has sufficient guardrails, right, so that we're protecting consumers and preserving market integrity and all of that. But what I would love to see is for that sort of competition, right, where you have traditional securities markets, and then you have options for investors to potentially engage with on-chain capital markets, and not just investors, but potentially issuers, right? If you have public companies looking to go public that want to natively issue their stock, their securities on the blockchain, we should allow for that sort of experimentation, and then let the consumers decide, let the issuers, the investors, the market decide which system is more efficient, which system is potentially better for investor fairness and market integrity. So I see it playing out that way, where we might have a period where you have traditional securities markets, right, and on-chain capital markets, potentially some hybrid, right, like where the players like the New York Stock Exchange and the DTC and NASDAQ experimenting with some hybrid version of that, and allow the market to decide which system is better and which succeeds. So I think that's where getting the regulations right and preserving that sort of flexibility for the SEC is really important.
So I want to slightly change gears here and ask you a little bit about the role of the states. All right. So, and that which will be very important if we don't achieve legislation here. But I'm interested, which would create some preemption. I'm interested in what your thoughts are regarding the role of the states in regulating this space. I mean, obviously, we're seeing a lot of activity in the prediction market side right now, where the states are litigating and enforcing all over the place there. But we're starting to see, of course, legislation in more states trying to regulate digital assets. Obviously, New York's been doing that for a while, but California is coming online with that this year, Illinois the year after. I'm interested in your perspective on that.
Yeah, I mean, there's just so much happening in this area in the courts, right? So, New York State introduced a bill that would require a license from their state financial regulator, DFS, to operate a prediction market. But a lot of the action right now is happening in the courts, right? There are a number of states that have sued the prediction market platforms like Kalshi, like Polymarket, claiming that they illegally offer sports betting disguised as federally regulated event contracts, which they argue violates state gambling laws. The prediction markets claim federal preemption, like you said, saying that they're regulated by the CFTC and that trumps any state laws. And then you also have the tribal lawsuits, right? So the tribes arguing that that these prediction markets are offering illegal sports betting in violation of the Indian Gaming Regulatory Act, which is another federal law, as well as tribal sovereignty. So these are powerful interests that the prediction markets are going up against. So the way these lawsuits have been playing out is that different states are actually starting to rule in different ways, which Renato, as you probably know, that is the best way to set up a circuit split, which is the best predictor, no pun intended, of whether the Supreme Court will eventually take up an issue, right? So I think this is going to come to a head eventually, and you could see the Supreme Court weighing in on this issue.
All right, we got to go. So this is the last question, and I want to come back to New York Stock Exchange, DTCC, these traditional institutions coming into the space. If market structure doesn't pass, what happens to these traditional institutions who have these highly sophisticated strategies to enter the space? Do you think they continue full steam ahead, or does that momentum kind of pause?
I don't think so. The train has left the station. Like I said, I think that the broader trend is new financial infrastructure like blockchain is enabling consumers to have more control over their money, the way that they transact with their money, how they earn on their money, and how much the value of that they capture versus intermediaries. That trend is not going to be reversed. It's actually a major paradigm shift that's happening right now, and the incumbents see it too, right? So, market structure has been in the works for a long time now. I mean, even from my perch, I work at a company that's building DeFi infrastructure. We talk to traditional financial institutions every day. They are not waiting around. They see the paradigm shift happening and they want to be a part of it. So no, I don't think market structure is going to halt the momentum. I do think, though, that it is necessary to have clear rules of the road if we want the industry to flourish, if we want to protect innovation, developers, builders, entrepreneurs, and just as importantly, consumers.
Thanks so much for joining the show. As always, it was a pleasure.
Thank you for having me.
That was Veda Labs General Counsel Tuongvy Lee. All right, Renato, it's just you and I wrapping it up here. Another great one in the books.
Yeah, no kidding. And boy, some really interesting and spirited conversations here. I mean, I think, when we were talking to Cara, we were really getting to the tip of the spear in terms of where the fault lines are. Obviously, as you said, it seems like there's a lot of optimism. We just heard that from me a moment ago.
Have you flipped to the optimism side?
No,
Okay.
I have not. I think it's, getting Republicans and Democrats to agree on anything in this climate is hard. It's just hard. And so I do agree that there were 78 Democrats who signed on to clarity. Let's see in the House. Let's see if that occurs in the Senate. But not having everyone swimming in the same direction is challenging. So let's see what happens. I certainly hope that there can be a compromise and an agreement, but I remain concerned.
Yeah, definitely a lot to talk about. We have our topics laid out, I think, for for the rest of the year on this show. Thank you to our audience for watching. We are here every other week on Thursdays at 12 p.m. Eastern Time. For Renato Mariotti, I'm Jen Sanasi. We'll see you later.